I think that looking at it year by year, that this is the third year of the expansion with a very aggressive monetary policy, and so we're in the part of the typical expansion where there's a lot of inflation pressures because it happened in a giant big way, and everybody's long. The world is it's the end of a paradigm because everybody believes that they want everything to go up. And of course, that creates a dynamic where policy is long, everything goes up. And of course, that happens by creating money and credit, debt, which creates debt.
Billionaire investor and hedge fund manager Ray Dalio believes the US dollar and fiat currencies around the world are locked in a spiraling and never-ending state of decline. Last month, in an interview with Yahoo Finance, Dalio says that on a scale of 1 to 10, his concern about inflation has jumped to between an 8 and a 10. At this point, he believes governments have no real way to control the decay in the purchasing power of their currencies. According to Dalio, the Federal Reserve's rate increases may slightly curb inflation in the U.S., but ultimately regulators will not be able to bring it down to an acceptable level. In a new interview on the Bridgewater Associates YouTube channel, the founders of Bridgewater discuss the big risks he is watching, including inflationary pressures, political conflict, asset bubbles, and climate change, and what investors can do to protect themselves. To watch the hour-long complete interview, please go to the Bridgewater Associates YouTube channel. The link is in the credit section in our video description. We have, however, edited the most insightful part of the interview to share with our esteemed viewers to save you time from watching the hour-long video. In the interview, Ray Dalio shares his fears for the U.S. economy as a result of the present inflationary economic environment. He also shares his concern for the present heated political environment and why he believes the 2024 election may lead to chaos. Before we listen to Ray Dalio, please take a second to smash the like button and subscribe to the channel if you are yet to do so.
The financial wealth has become enormous relative to the real wealth. Everybody who's holding bonds or assets, particularly the debt assets, believes, or financial assets in general, which are just journal entries, they're claims, but they believe that they can take that buying power and sell it and buy goods and services, and they can't. And by its necessity, there must be negative real returns, negative returns relative to buying power. So if we take it chronologically, I think there's the short-term cycle, which is usually the business cycle, takes 7 years on average, and give or take, depending on where you start the cycle, give or take a few years. I think we're moving along here quicker. So we're now going to be in a very tight environment, and that changes everything. So when we look at the returns of equities, and we look at the well-being of companies, you see that the cost of interest relative to the expected returns of equities creates a squeeze on equities, changes the economics. A lot of borrowing has been done at much lower interest rates and so on. The return on equity for a company and versus the return, the cost of debt is changing, and all of those things are changing. And like all bubbles or paradigm shifts, the mentality that did exist, we don't have to worry about inflation, cash is a safe place, and so on, gets a shock. There's a punch in the face. There's been a 40-year bull market, and there's a punch in the face to all investors. We're going through it as Jeremy describes. And when that happens, things that were never supposed to happen, because everybody believes in the tech companies, and that which is the same as the Nifty 50 or the .com companies, they get hammered, right? So like you say, 75% decline in Cathie Wood's funds, and so on and so forth. That causes the adaptation. So we're in the beginning of that adaptation. That is most similar, I think, to the 1970s period. And it becomes financial. So I think as we'll come to the 2022 elections, and that'll have economics and markets has a big impact. So we'll be in the 2022 elections. I think that you'll see greater political extremism coming out of that. Moderates are leaving, and even those who are running are populists. Populists are people who will fight to win and will not accept losing and will fight for their constituency. So you'll see more populism of the left and more populism of the right. So if I look at 2023, I look at 2024, and I'm worried about the neither side accepting losing. And I think that there's a big risk that that the system is in jeopardy, because history has shown when the causes that people are behind are of greater importance to them than the system is in jeopardy. Those types of things change the world landscape. I'm emphasizing the United States, and certainly Europe is in that type of a position. So I think that when I look at it, it'll be very important to not only diversify well, but to be able to be long and short different assets in order to perform well in that environment.
U.S. inflation has reached its highest point in nearly 40 years, as the COVID-19 pandemic has caused both supply and demand-side shocks, with a disrupted supply chain, unprecedented levels of government fiscal stimulus, shifts in consumer spending, a decline in labor force participation, and persistent business uncertainty. Inflation has been relatively low for so long that few U.S. executives have managed organizations through periods of high inflation, with little direct experience to guide them and growing uncertainty about what the future may hold. With a high rate of inflation, higher prices outpace wage growth, making things like gas and rent more expensive for consumers. For that reason, the Fed imposes interest rate hikes as they did in March and May, with 5 more expected to follow this year. These hikes discourage spending by making the cost of borrowing money more expensive for businesses and consumers. This slowdown is also showing up in public opinion data. A CNBC Momentum poll last month found that over half of Americans have already been dining out less, and that over 1/3 have cut back on driving or canceled a monthly subscription. Such spending reductions might grow in severity. 40% of respondents said that if higher prices persist, they will consider canceling a vacation, and 76% expressed concern that higher prices will force them to rethink their financial choices. Reinforcing these findings, inflation has driven the University of Michigan's Consumer Sentiment Index to its lowest point in a decade, lower even than in the spring of 2020 when the COVID-19 pandemic caused an abrupt surge in unemployment and a severe economic contraction. Stagnant spending and softening plans for future spending should not be surprising, considering that inflation has reduced real wages for most workers. So far, consumers have largely maintained current spending, despite what higher prices mean for household budgets. But that won't last forever, and it may not even last into the second half of the year. Consumer spending is the primary engine of the U.S. economy, making up about 70% of the nation's gross domestic product. That's why the signs of struggle from retailers, grocers, and wholesalers are troubling. Companies are facing tighter margins and swelling inventory, and they have yet to pass the cost fully on to consumers. If they do, inflation for the average household could get even worse. And the economic outlook continues to dim. JP Morgan said this week that the market is pricing in a 70% chance of near-term recession, suggesting investors lack confidence the Fed can contain inflation without triggering a downturn. Fed Chair Jerome H. Powell himself recently said the central bank should have moved faster to raise rates and has left the door open for more aggressive action. Here at Savvy Finance, we believe the inflation will get worse and will probably lead into a recession. Crypto and Bitcoin in particular is your best hedge against inflation and the coming financial difficulties many will be facing in 2022. Start buying Bitcoin if you are yet to do so, especially as Bitcoin is presently on sale. Dollar cost averaging is the best way to invest in Bitcoin. Thanks for watching. Till our next video, please stay savvy.